really need to go back to this chart once again, as everybody's touting that we are bottoming out. Mainstream media, economists are saying this could be the bottom, or we are near the bottom. Let's just remind ourselves that the home price index peak to trough to June 2019 by CoreLogic says that Sydney has dropped 14.9, Melbourne 10.9. Another interesting one is the Perth 19.8. Now these time frames of them reaching peak to trough are different, but nevertheless this is what the difference is between the top prices to where the bottom was, and we're pretty much at the bottom now, except this is why they tell us that we are turning the corner. So having all of these fall down in the span of let's say close to 2 years on average, down this much. Only Sydney has gone back up 0.1%, Melbourne's gone back up 0.2%, and Hobart's quote-unquote recovered 0.2%. Everyone else keeps falling. And this is just June, only for June. What happened in June is, again, Sydney's up, Melbourne's up, Hobart's up, just marginally, and then you got the rest, including all the capital cities average is 0.1%, regional 0.4%, and national average is still 0.2, yet they're saying we are bottoming out, and we'll probably never hear the end of it until it continues to go down. Now, because this channel is all about education and enlightenment, I watched this video from probably the most underrated YouTube channel on the internet, especially when it comes to real estate, is Formafist, and the video is called Real Estate Fall 2019, Vancouver to Toronto to Australia. Very relevant, and I'm not going to spoil it by showing you something. And also, we're just going to revisit what the current state of the banks is. I remember creating a video a while ago where it was all about don't go into banks. A hint as to what to expect to see in this video, without spoiling it, you must see it, is that Formafist's Twitter says a good reminder for any Australians reading headlines like this: Sydney, Melbourne hint at housing revival, while pointing to a 0.1% increase for June, as we just saw. Now, he links to a tweet from Joseph Walker, who made an unbelievable point that in the Irish housing bust, Dublin residential property prices fell 59.1% in real terms from a February 2007 peak to May 2012 trough. Now, during this period, prices recorded small increases in May 2008, 0.1%, August 2009, 0.1%, and August 2010, 0.5%. So imagine that we are at the stage of May 2008 of Dublin residential property market, and it's just shown some life, gone back up 0.1%, exactly the same as Sydney, and they would have been saying, this could be it. So more than a year later, in August 2009, then it keeps dropping from the May, and then a year later, or more than a year later, in August 2009, it has another little recovery, if we can call it recovery, 0.1%. And I can imagine that everyone was saying, well, this actually could be it now. I mean, it's gone down so much that this will have to be it. And no, it continues to go down for another exactly year. And in August 2010, well, that surely needs to be it. 0.5% this time revival. We are bottoming out. And this is the Dublin residential property market bottom. So we're going back up. No, it didn't, because as we know, it continued to go down for another nearly 2 years into 2012 trough, when the overall peak to trough was 59.1%. Now, I did not spoil this video for you. You really want to go and watch how he compares this to a Japanese property market, what happened there and how it slowly eroded, and then what's going on with the Vancouver and Toronto in Canada, which are also booming. They're very similar to Sydney, Melbourne, or the whole Australian housing. Now back to the banks. Apparently they're in trouble, they tell us once again.
Borrowers toasting lower rates, but a sober outlook outlook for banks holding $1.5 trillion in mortgages. Major banks are among the most profitable in the world, but they're facing significant hurdles. A slowing economy has seen record low interest rates, squeezing margins, and regulators are also breathing down their necks, forcing up scrutiny and costs. Someone has to pay. Shareholders will be protected as much as possible, the easiest targets as savers. Here's finance correspondent Philip Lasker.
Retirees Gil and Elizabeth are watching their pennies. Their interest income is disappearing before their eyes.
We looked at it the other day and it's barely enough to buy a pizza, and definitely not a gourmet pizza.
With every cut, the impact on bank profitability accelerates and savers are the biggest losers.
Those who have prudently put money away are effectively going to be subsidising those who have borrowed. And the more that someone's borrowed, the greater the victory.
Georgia and Joel are winners, but they're cautious.
I don't feel optimistic at this stage. It wasn't that long ago that we were told that interest rates at 3% were at emergency levels, and now we're down at 1%.
The home they bought 2 years ago may be worth less, and a hefty mortgage makes them feel vulnerable. They won't be spending the tax and interest rate cuts in the stores.
Our plan with the mortgage is to get rid of it as soon as possible.
Not only are households saddled with debt, but the market is saturated with mortgages. It's another hurdle for the banks.
The capacity for credit growth to grow from these levels, with the banks holding $1.5 trillion of mortgages on their books, is difficult. And some of these other areas where they're earning decent returns, such as the fees, won't be there in future.
That's thanks to increased competition and the Royal Commission highlighting the scandalous charging of fees. Lending standards have been eased, but they remain tougher than they were at the height of the property boom. ASIC has asked banks to explain why they shouldn't be required to verify every part of a borrower's financial circumstances. All this adds costs to the business of banking.
It is an adjustment to what has been a very profitable industry over the last 30 years.
A big part of the adjustment is the transition to a period of ultra-low interest rates. Every cut is costing the banks 3 to 4% in profits because the money they pay savers through deposit rates can't go much lower, but borrowers are receiving bigger discounts on their home loans.
In a loan growth environment where they're hoping that loans will pick up, deposit growth needs to be at a similar level. But we now have a low interest rate environment which puts pressure on deposit growth.
Banks are sitting on more than $2.8 trillion in deposits, but growth has slowed since 2015. They're also paying less than the Reserve Bank's cash rate of 1% for 30% of that savings pool. Investors who need savings to generate income, like self-managed super funds, have been holding less cash as a proportion of their growing funds, taking on more risk and keeping only enough cash to pay their pensions.
If you're looking at the other available options to generate income as a saver, you're not spoilt for choice.
As Australia's interest rate structure falls, investors are buying bank shares, ignoring the increasing hurdles faced by the sector over the longer term, like weaker loans growth and higher costs.
If earnings in 2 years are threatened, if we have higher regulatory costs, and if bad debts return to more normal levels or unemployment increases, you could see bank dividends cut.
There is always the pension, but Gil and Elizabeth see themselves as victims of an intergenerational battle.
And the ones that are out there buying homes at the moment, so few of them have learnt how to save. And we saved, and now we're being penalised.
They are, in fact, collateral damage in a battle to speed up a flagging economy.
Apparently it's not only our banks and savers that are struggling, it's the international banks like Deutsche Bank.
And bank woes continue, with Deutsche Bank's Australian business caught up in a sweeping restructure. The German giant announcing 18,000 jobs will be slashed globally by 2022. The company's equity business is in the firing line, with staff briefed on the weekend about a retreat from financial services. The global job cuts announced by the Frankfurt-based bank will reduce the workforce to 74,000. Deutsche Bank has struggled with regulatory fines, weak profits and a falling share price. To the markets now, and the ASX posted its worst fall in 5 weeks. Oh, they took away the lollies from the market for this month.
Yes.
Our banks also got hit quite hard today as well. We've spoken about this earlier in the program, but it's really that concern about margin compression as interest rates fall that's really concerning investors, isn't it?
Banks won't make the kind of margins they were through 2013 to 2017 with the housing-led recovery. That gap, that margin will not be as strong. Regulation is higher. The amount of capital they have to hold on their balance sheet is higher. All of that is why most analysts now believe they're not going to do it. The other thing they're clearly targeting is dividends. The expectation is that CBA and ANZ are the most under pressure to probably look at either holding or possibly cutting dividends. So all of that together is why, leading into earnings seasons, banks are now under pressure.
Well, there you go. Apparently, banks are in trouble once again. Now, please go and watch this video, Real Estate Fall 2019 by Formafist. I'll link it in the description for you as well. Thanks for watching this video, however, and we'll speak again next time. Take care.